at least नहीं वेबिनार स्टार्ट मत करो, रिकॉर्डिंग शुरू मत करो, वेबिनार update call. What I intend doing this time is talk very briefly about our investment philosophy, because that's the key. I'll not delve into significant depth in this session, but very briefly we'll take you through the thought process. Then we'll talk about the macro situation, global and India. How do we pursue it? Then we'll talk about how the financial performance of India in corporate and for portfolio companies have been, because this is pretty critical. While the world continues to remain pretty erratic, but at the end of the day, value creation happens when businesses deliver onto financials over a long period of time. Shorter term, there can be violence, but longer term, it really matters. And then we'll take you through how the portfolio has been positioned and very briefly on performance and the flows. So this is what I intend covering this time. Coming to the philosophy, see, fundamentally, if you think about ASK and IEP portfolio in particular, we think about investments from a pretty long-term perspective. That entails investment into high-quality businesses, businesses where size of opportunity is large. In fact, size of opportunity large not today, but how will it play out over next many years? That's crucial, because what is important is the opportunity that will play out, which will allow the businesses to kind of grow. And that's relevant, because if opportunity is stale, businesses which kind of tend to grow in that stale opportunity would mean that profit pool for the industry may not significantly increase. And to that extent, value creation is not that easy. So really, what is important is look for large secular opportunity size. Within that, if we focus on high quality businesses which are run by solid management, businesses where execution prowess is really high, businesses which have built moat which cannot be copied so very easily, what would follow is earnings growth, and a very secular, decent earnings growth for next many years. And this allows for a very sharp value creation. Incidentally, if we buy businesses where quality of business is solid and earnings growth is sustained and consistent for a length of time, and when we buy that at a price which has reasonable margin of safety, what would we get is, in many cases, value creation being higher than the growth itself. And that's pretty critical. And because at the end of the day, we all are here to create pretty superior long-term value, and value which is not very, very volatile. So that's the thought process when we kind of look for any business. Within this thought process, we generally look for few important aspects, and these are pretty important principles that we follow. For us, certainty of earnings is significantly more important than mere quantum of earnings growth. Even if earnings growth is not very large, but it is still decent for a length of time, longevity is very important. That to us is a much superior earnings, much superior value as compared to earnings growth, which comes in short spurt of time and is very erratic, not very predictable. So we would actually look for former. In fact, we are people who would like to buy businesses which are pretty superior. If we get a superior business at fair price or attractive price, that to us is a far superior value proposition as compared to buying a business which is available at very attractive price, but qualitatively is pretty inferior, because we believe that time is a friend of superior business and an enemy of an inferior one. We all know how times are. They will never be certain. The uncertainty in the environment will keep increasing. And the ability of a high quality business to tide up or tie or face the uncertain environment is going to be dramatically higher than that of an inferior one. And we don't want to get into a situation where the inferior business just keep kind of getting really inferior over periods, such that the relevance of that business keep going down. In fact, value creation happens when the relevance of that business over period increases. So this is the overarching principle, and IP in general, or IP in particular, focuses on high quality promoter owned businesses. And that's very important because we believe that promoter ownership actually makes a significant difference. It's the promoter who actually kind of tackles the market on a day-to-day basis, and his vision, his execution, his strategic move actually allows for value creation over a long period of time. In fact, they themselves have skin in the game. And so to that extent, the alignment of interest is kind of similar. So to that extent, this is a portfolio which focuses on Indian entrepreneur-owned businesses and kind of create value over a long period of time by investing into such businesses. With that thing in mind, let me take you through how we perceive kind of markets, how we perceive economy at the current juncture is playing out. See, when we look at the environment, I mean, generally we tend to think or we read negative news most of the time because times have never been certain, and markets for last 15 years have continued to climb wall of worries, and this time is no different. What are the key worries? I mean, these worries can actually be divided into short-term worries, which are more cyclical, and then there are some worries which are kind of more structural. We need to see how those things play out. First and foremost is inflation, which has actually, I mean, while today we may be talking of moderating inflation now, but at the end of the day, it has remained pretty sticky and at an elevated level for a length of time. While commodity inflation may have come down, services inflation continue to remain at an elevated level. We need to see how that plays out. We really believe that inflation probably may have reached almost peakish level, and we won't be worried of inflation at the current point in time. In fact, we actually would think that the way inflation or the way drivers of inflation which I will take you through in the subsequent slides, they have actually started to turn already. And so to that extent, our worry on this front is not very high. In fact, not only is inflation not a worry anymore, we don't believe that interest rates would also be a large worry from here on. And interest rates has a pretty interesting impact on valuations as well, because at the end of the day, interest rate actually leads to higher cost of capital, and higher cost of capital leads to impact on valuation. We believe that the worst phase of that probably would be behind us, because the pace at which we saw interest rates going up in different parts of the world has been a case which we have not seen for many years in the. So this is pretty important. Another important aspect is, if you look at most of the economies, the way they have doled out subsidy at the time of COVID. Today, the debt level of most of these economies actually is at pretty precarious level. And in an environment where interest rates have gone up so dramatically, the after effect of that actually should be witnessed probably going forward into future. So this is one area where most of the countries actually are vulnerable. Indian position actually is far superior, better. India's debt to GDP actually is 80-90%, and our external debt actually is at a significantly lower level. So India actually is at a position which is dramatically superior than many other parts of the world. Then there are some structural worries. First and foremost is all about climate change, and no doubt world over there are discussions that are taking place with respect to how to kind of tackle this climate change, and to that extent there are targets being taken by many of the countries as well to come to net zero within defined time frame. India also has been signatory to that. But at the current point in time, we already are seeing impact of this climate change. We are seeing impact, I mean, kind of seeing flash floods in few parts of the world, or extreme weather conditions in many parts of the world. So this has kind of become an event where world will have to recognize the problem and take corrective actions. Second aspect, which is again a very important one, is about aging population. India, again, given its superior demographic profile, stands in a better position as compared to many other parts of. But with what has happened after Russia attacking Ukraine, the geopolitical situation has become pretty interesting, and we'll have to see how this whole environment plays out. And consequent to that, we have now already started to see fear of dollarization. What do I mean by that? See, I mean, for many years now, dollar has been a central currency, and a lot of trades was taking place in dollar. Today, if you look at the composition of dollar in forex reserves of many countries, this has already started to come down. Gold in proportion has increased, but the whole challenge is there any other currency which can replace dollar? At least for some time, there isn't anything. But having said that, regional trades have already started to increase. India also is trying to do trade in INR. It has signed up with almost 16 to 17 countries with respect to trade in INR. So to that extent, this is a phenomena which will, over next multiple years, have a far significant impact probably on how trade globally can play out. Now, let me take you through what are all the global indicators? What are all the global things? I was talking about inflation kind of coming down. And if you look at many of these commodity prices, oil is down pretty sharply. Steel, aluminum, zinc, copper. And if you think about copper actually is nothing but the barometer of how economic activity in the world takes place. And especially for China, and it being down clearly shows the situation in terms of growth in the world is not very high. If you look at agri commodities as well, they have come down from highs, but we'll have to see how this kind of plays out, because this can be pretty erratic. Having said that, the way commodity prices have come down, energy prices is down. I think this should help ease inflation world over. Agri commodity prices already are down close to about 20% from their highs. What is driving this change in commodity prices? First and foremost is demand. This is very important, and the way world is kind of slowing down, obviously demand also has come down. But not only is demand a factor, if we look at supply chain as well, which kind of got impacted pretty sharply at the time of COVID, has now come back to more or less normalcy. Pre-COVID, the cost of moving a 20 feet equivalent, 40 feet equivalent unit of container from China to east coast of US, which, I mean, it used to cost about $2,000 to $2,500. Height of COVID, or rather during COVID, it reached almost $22,000. Today, now it is back to pre-COVID. I mean, this is nothing but supply chain kind of normalizing. And with all this, if we look at inflation globally and interest rates, we believe that we have kind of, while we have seen very sharp hike in interest rates over last many years, over last 1 year, I think most of this hike is done. We should be closer to about highs already. In that context, if you look at India as well, in the last MPC meeting, we kind of didn't change the interest rate. So repo rate continues to remain at 6.5%. And we believe that probably we should be closer to highs here as well. In that context, let me take you through how India is kind of behaving at the current point in time. And there are multiple facets to India's macro story. If one looks at all the factors and talking about manufacturing first, this has been a star performer. Manufacturing actually has started to increase or do relatively well after many years. For last 10 years, there was largely one engine that was firing, which was consumption. Now we believe that both engines actually will fire. Not only will consumption continue to do well, manufacturing will also continue, or rather at the current point in time, doing better than what consumption is doing. Invariably, higher growth in manufacturing will feed in to a strong growth in consumption as well. And what are all the indicators which are kind of showing that manufacturing is kind of doing well? I mean, look at how GST numbers are playing out. While GST is also a reflection of better compliances, but at the same time, it is also a reflection of how economy is kind of doing. If you think about GDP as a GST as a percentage of GDP, it has already been, I mean, kind of crossed 6.5% in FY23, and this ratio actually has been increasing. So clearly talking about better compliances in the country. Right? So India as an economy, India is also kind of getting a lot more compliant. If you look at GST numbers, we have been upwards of 1.5 lakh crore on a monthly basis for many months now. If you look at fiscal deficit, it has actually been managed really well. We anticipate fiscal deficit for next year actually to be close to about 5.9%, which is going to be almost 50 basis points lower than what we saw in FY23. And what is important in this fiscal deficit is this fiscal deficit is not at the expense of compromising on capex. Incidentally, if you look at the chart below, if you look at government expenditure, over last few years, capital expenditure as a percentage of total government expenditure actually has been going up. In FY23, this inched up to almost 18% of the total government expenditure. Capital expenditure was close to about 18%. This number actually can cross 20% in FY24. So to that extent, the fiscal deficit actually is funding capex, which is a very important aspect, and which would mean that this dynamics of higher capex would lead us to a structural long period growth, and a growth which can actually be really sustainable. If you look at direct tax collection growth as well, it has actually been at a number which has been pretty decent. So overall, tax collection numbers have been decent. If one looks at how GSEC has also played out, it has come down from highs. From peak of about 7.6%, it is now already down to 7%. And why has it been going down in spite of economy kind of doing well is, if you look at inflation, more than CPI, WPI actually has trended down, which is again very important. So WPI actually, lower WPI can mean that CPI also incrementally could start to trend down. And this has been achieved not by compromising on Forex. Our Forex actually at lows reached to about $524 billion. Today, it has already increased to about 593. Right? So clearly, about $600 billion of Forex reserves, a pretty decent number from how many months of imports that we can cover. So pretty. So on an external front, we are well placed, not too much worried here. Coming to the credit growth, India has been clocking credit growth upwards of 15% for a while, and we believe that the way things are playing out, our overall credit, which is close to about 50% of total GDP, actually has scope to kind of be higher. So effectively, what may happen is credit growth can continue to grow at a rate faster than our overall nominal GDP. So if we believe that our nominal GDP over next many years can be close to about 10-11%, we believe that credit growth should be a tad higher than that. Within credit, while industry credit has been erratic, retail credit actually has been clocking a pretty decent pace. We believe that retail credit growing at 17-18% is a pretty likely scenario over next many years. So that is where most of our investments also has been focused on. Now with this backdrop in mind, let me take you through how the business performances in the quarter gone by has been. If you look at IEP portfolio, at an aggregate level, the portfolio profits actually grew 21%. while for Nifty 50 has been close to about 16%. So materially higher growth of the IEP portfolio versus that of Nifty 50. I'll come to it in a while as to what are the sectors that are contributing. But not only Q4 FY23 has been higher for portfolio companies, FY23 also has been much superior. For FY23, our portfolio companies would have grown profits at upwards of 25%, or rather close to about 25%. FY24 and 25, we continue to anticipate profit growth for portfolio to be significantly higher than Nifty 50. We believe that a higher sustained profit growth versus overall market is something that would allow us to create relatively higher alpha, or alpha versus markets as a whole. And this has been something that we have been focusing on. Not only earnings growth is relevant, but at the same time, how has capital efficiency behaved is a very important aspect. And ROC of our portfolio companies continue to remain very solid and pretty superior versus benchmark. For benchmark, ROC should be close to about 15 to 17%. For our portfolio companies, this should be upwards of 35%. So to that extent, materially superior ROC and the superior earnings. What has been the contribution, or which are the sectors that have kind of contributed to earnings in this quarter gone by? Clearly, lending businesses have been a star performer. Not only did banks report superior earnings, NBFCs, especially vehicle financiers, reported very solid earnings in this year. In fact, banks grew. I mean, we have seen how the credit growth in the system have been. Most of these banks have reported credit growth higher than the system growth. NBFCs, vehicle financiers, or consumer finance NBFCs also have reported growth which is higher than the credit growth. Not only that has been the case, NIMs also have been either flattish or have inched up, which have contributed to kind of higher profit growth versus AUM growth, and asset quality continues to get better. This gives us confidence that not only can banks or grow faster than grow fast, but also the stage or state of our corporate also is pretty superior, and which is why we believe that credit cycle is something that actually should continue to do well. Other businesses like automobile have recorded pretty solid numbers. Volume growth have been decent. Two-wheeler may still have not, I mean, there we may have seen flattish numbers, largely because of decline in exports, but domestic two-wheeler have still grown. While two-wheeler as an industry may still be lower than what it was in 2019, but yet on a YOY comparison, numbers have looked decent. Going into FY24, we believe that CV cycle should continue to do well, given the fact that average age of CVs in the industry continues to remain lower than what generally should be the case. So that would mean that the replacement cycle for CVs should continue to chug along. And when economy does well, CV cycle also continues to do well. PV should also continue to report, passenger vehicles should also report decent numbers. And we believe that two-wheeler should kind of grow from here on as well. So to that extent, pretty decent outlook on automobile. Not only volumes expected to do well, we saw pretty sharp margin expansion in automobile businesses, and that has aided kind of profit growth. So lending businesses, automobile businesses have recorded very solid earnings growth in the quarter gone by. Consumer, which has been an area where we have had a very high focus on, it has reported mixed set of performance. Discretionary businesses actually have done well. Staples, we saw impact on volumes. Within staples, we believe that rural, which was kind of impacted more than the urban, so urban did well. So consumer has been a classic case of K-shaped recovery, wherein discretionary did well, jewelry businesses did well, paints did well, cigarettes did well. Alcohol, the upper part of alcohol actually did well. So to that extent, the discretionary businesses actually grew much better than staples. Within staples, urban did better than rural. Even within rural, we believe that the numbers probably would have kind of started to bottom out. We already have started to see some signs of recovery there. So this is one area where we believe that growth from the rural side should accelerate. Engineering and infrastructure businesses, they had a dream run. Not only order book has been solid, their revenue growth also has been pretty decent. And obviously, these are businesses where when revenue comes by, margins should also be buoyant. So we are in a decent cycle on engineering side, and we are pretty confident that Make in India actually should be a theme that will play out. Make in India and for the world, which would mean that many of these chemical businesses over next many years should do well. Pipes businesses, which would aid the engineering side, should do well. So that is where it has been for engineering and infrastructure businesses. What has been disappointment? IT businesses in particular, or businesses which gets impacted because of global vagaries. So whether it is IT business, whether it is commodity business, they have had a pretty dramatic impact. Especially commodity businesses have had a pretty dramatic impact on their profitability. IT businesses, their numbers also have been either in line or lower than estimates in many cases. And given the way global economy is kind of playing out, our confidence on domestic businesses doing well is significantly higher. And which is why, from a portfolio perspective as well, we have focused more on businesses where exposure towards domestic side is high. This talks about, how each of the portfolio companies have kind of reported results. And many of the companies, barring Metropolis, barring Page Industries, and barring Divi's, have reported pretty decent earnings growth. So by and large, I would say the corporate performance for our portfolio companies and for the India Incorporate has been decent, and we are not worried on domestic businesses kind of doing well. Coming to how the portfolio is positioned, as I talked about, consumption is a pretty decent theme for us, because if one thinks about how per capita GDP over next 10 years kind of will play out, we believe that per capita GDP can be at least 2.5x from what it is right now over next 10 years. That could mean that the consumption pattern of the country also can change dramatically. Discretionary businesses ought to grow at a rate faster than how overall consumption should grow, because as country kind of sees income level increasing, premiumization is a natural fallout. And consequently, we have a pretty decent exposure towards consumption. And we believe that most of these consumption businesses are invariably distribution-oriented businesses. And distribution can't be copied so very easily. Right? So entry barriers in these businesses are very large. And the ability of these businesses to increase market share across varied business environment, they have displayed it to be pretty decent. So we have a pretty decent exposure towards consumption, and most of these consumption businesses have recorded pretty decent, have not disappointed in the quarter gone by, and we continue to anticipate that the growth there should be decent. Financials is another large area within the portfolio, but our exposure towards NBFCs is relatively higher than that of banks. While for BSE 500, it is inverse. NBFCs have a relatively lesser exposure versus banks. We believe that the NBFCs that where we are exposed to invariably should grow at a rate much faster and with a very superior ROE. So this gives us confidence that these are NBFCs that should do well. Not only they are growing faster in their own area of operation, over period we have seen their ability to get into new verticals also has been, or rather adjacent verticals also has been very high. And that allowed them to kind of report pretty decent disbursement and consequently AUM growth. Then we have relatively higher exposure towards healthcare, telecom, and some bit of manufacturing in India. Right? What do I mean by manufacturing in India? Beneficiary of the supply chain dislocation that we are seeing. So chemical businesses or something like pipes businesses, that is where we have reasonably higher exposure. Yeah. In that context, if you look at the characteristic of portfolio, we anticipate earnings growth to be about 20% plus in the next 2 years going forward. FY23, some of our businesses also got impacted because of pretty sharp fall in commodity prices. We don't anticipate that thing to play out unless commodity behaves in a very erratic manner. We don't anticipate that to play out. So FY23 is going to be a year where we should see some bit of margin expansion as well. So growth would be aided not only by revenues, but also by margin expansion. So earnings growth is one driver. And if you look at ROC, we believe that ROC should accelerate to 40% plus for next 2 years. So pretty superior earnings characteristic and qualitatively pretty superior businesses. Now let's come to valuation, how it has played out. If you look at trailing P of the IEP portfolio for last 8-9 years, from its peak, the trailing P is down almost 30%. So while P may be down, earnings growth continue to be at a decent pace, and which is why it is kind of reflecting in P. And the way we see earnings playing out, the way we see capital efficiency playing out, the way we see these businesses kind of increasing their dominance in their own area of operation, the way they are utilizing technology to increase lead versus competition, we remain pretty confident of a pretty superior earnings delivery from our portfolio companies. This is the performance. If one looks at the performance of IEP on a calendar year basis and compare it with the BSE 500 TRI index, 10 out of 13 calendar year, this portfolio has outperformed benchmark. Last year has been a difficult year wherein the market also has been pretty lopsided. It has been pretty concentrated. This year actually is tracking well. Already the portfolio on a year till date basis ending 31st calendar year till date basis is up 5.6%. On a fiscal year, this portfolio is up 15%. With that, let me take you through how the flows have been. While I have covered IEP portfolio, let me take you through how flows, how internationally India is being perceived. So clearly what India offers, because that's also a function of how is India relatively placed. India offers stability of policy, fiscal and monetary as well, lower inflation differential, and consequently over last 3 months, we have seen a pretty solid FII inflow. I believe, given the way things are, I will not be too much worried of how FII's flow into the country plays out, because India is still underrepresented in many parts. In fact, if you look at overall India's GDP as a percentage of global, which is close to about 3.5%, India's representation in many of the portfolios is lesser than that. While in emerging market, it may be closer to about 12-13%, but on an overall basis, we are not represented in a manner that we should be. So I believe the way things are playing out in other parts of the world, especially China, and India's relative positioning, the scope of India continuing to get FII flows should be decent. And not only FII flows should be decent, but Indian domestic investors' money is also not completely represented in Indian markets. And overall, our domestic allocation into equity is still lower than what it should be. So to that extent, longer term flows should be decent in the markets. Yeah. So I'm open for questions, whatever that means.
Okay. Thank you, Sumit. Thank you for this insightful session. I think questions have already started to pour in as we speak. I think let's address one question after the other. The first and the foremost question that came in was, what's our outlook on or our house view on pharma and healthcare as a sector and chemical and agri-chemical businesses? Okay. So what's our house view on these particular two sectors specifically?
See, if you think about pharma, the earlier cycle was about providing generic medicines to the world. India continues to remain pretty decent there, while many of the businesses may not be making money there, which are doing business with on the US generic side. But domestic pharma is a solid opportunity. That industry in India has been growing closer to about 10%. And we see no reason why growth rates over next many years should be any different. As income level increases, as penetration of businesses kind of gets better, this kind of growth rates should be sustainable for the and businesses which kind of focuses on right distribution, right brands, actually should grow at a rate faster than that. So there may be many businesses which can actually, a decent size as well, can hope to grow 2 to 3 percentage points higher than growth in overall industry, right? So we believe that the outlook for domestic pharma businesses is decent. Outlook for US generic, if you think about it, is also pretty interesting. US generic, cycle has already been about 8 years now. It peaked somewhere close to in 2015. Right. Now we are seeing many of the large pharma companies starting to say that we don't want to focus on US generic space as much, because profitability has been difficult to come by. And that means that cycle actually at some point can start to turn. So to that extent, outlook is more positive on domestic pharma. US pharma actually is a more cyclical one. We need to clearly watch out for as to how that plays out in terms of cycle. But not only pharma businesses outlook is decent, but if you think about insurance within pharma, that's a very underpenetrated one, right? Retail medical insurance actually over last many years have grown at 20%. Why should it not continue to grow at that rate for next many years? Right? We are significantly underpenetrated here. Think about businesses like diagnostics or hospitals. Those are also pretty underpenetrated. And as there is formalization, many of these organized will actually grow at a rate faster over a longer period of time. Many of the hospitals also have started to report capital efficiency, which has been pretty decent. So we remain positive on pharmaceutical space. Coming to chemicals, see, for us, chemicals is a story where longer term, India actually can be a big manufacturer for the world, right? So we have to identify businesses where there is a decent amount of R&D skill set that is required. We don't want to kind of focus too much on run-of-the-mill commodity businesses, because those would be at the vagaries of how cycle plays out in those chemical businesses. Our idea on chemical would be to focus on businesses where there is decent amount of entry barriers. Businesses work with a large innovator, agrochemical or pharma companies there, and business is a lot more sustainable. So that is something where we believe that there is an opportunity. And agrochemical, India has not seen, I mean, many of these domestic agrochemical companies domestically have not grown as much, but it can't be that way. While longer term growth may not be high, but over period, this can be businesses which can still grow 8 to 10% for many years. Yeah.
So just to add to this specific stuff, your maybe some inputs on Aarti in the chemical space and Metropolis, which is in the healthcare space, both have seemed to be a little loose in terms of performance. Any input on those particular two names?
See, Aarti Industries actually got impacted. I mean, this is pretty interesting. When we saw supply chain kind of getting ruptured world over, corporates actually stocked up significantly higher inventory in many cases in chemicals as well, right? Because obviously there is going to be higher inventory in the channel with the consumer, with the customer, both, right? When supply chain kind of starts to get normalized, inventory in the channel starts to go down. So it has got impacted because of destocking and also lower impact on, or rather higher impact because of lower demand globally. And which is why numbers actually have been lower than estimates. And when a company which is in a very solid expansion phase don't see revenues coming up the way they envisage, margins actually get impacted relatively high, and which is why numbers have actually been lower than estimates. In case of Metropolis, the non-COVID business, which is more B2B, B2C, normalized business, actually has grown at close to about 15%. And we believe that it should continue to grow at that rate for next many years. COVID business is where there has been an impact on, because that was there in the base. It actually has got impacted because of sharp or significantly higher competition. And these are two businesses, Aarti and Metropolis, where we have actually trimmed position because business is taking longer than in terms of normalization, normal than what we would have envisaged.
Sure. Another question that is coming up is, while Sumit, we agree that we had a tough 7-8 months in terms of underperformance, which was seen in IEP portfolio, and we have seen a reasonable comeback in last couple of months, where we have been able to outperform the benchmark in a certain way. The point is, while the agony or the pain has got reduced, there is still continuing to be some impact of that. So the point is, what is your outlook for maybe next 1 year, 2 year, or 3 year in this IEP portfolio, and how should investors look at it? I mean, should we add it? Should we look at maybe holding it? And what's the way that one should look at IEP for the next 1 to 5 years kind of a period from here on?
Sure. So see, what are the key pillars of value creation? One, does business have a large opportunity size? That's something that we actually focus on too much. In fact, I believe most of the businesses that we have invested into, the runway for growth for these businesses actually is pretty high for a length of time. So within that opportunity size, are these business able? Do these business have ability to execute? And if I look at the earnings of these businesses, this year has been a pretty decent earnings growth, in spite of the phenomena where commodity prices, sharp fall thereof, actually impacted margins of these businesses. Yet they have still reported pretty decent earnings growth. And not only earnings growth have been decent, capital efficiency also has been at a pretty decent level. So these are, in a way, principles of value creation over a long period of time. Even in the past, when we have had some performance challenges for some time, we always focused on the quality of businesses, the strength of businesses, the market share positioning of those businesses, relevance of those businesses, and we have taken calls accordingly. I continue to see a pretty decent business performances from our portfolio companies. Wherever there have been some bit of, I would say, disappointment, we have taken some corrective calls already. And markets are such; they are never linear. Businesses can continue to deliver, but the reward or the penalty both can be non-linear as well. So to that extent, while 2 months have been a pretty short time frame to say that we have done very well, but longer term, given the fact that the business performance is decent, that gives us confidence that the superiority of our performance should be very high. In fact, if you look at our performance, 10 out of 13 years on a calendar year basis, the portfolio has done well, right? So to that extent, the core philosophy has remained the same, and it is simple: focus on high quality businesses with superior execution skill set, and that has ability to deliver superior cash flow growth. So this is what we kind of keep focusing on, and I believe results actually is follows how businesses kind of perform over long period.
Sure. We have seen some new addition into the portfolio. There has been a question which has been coming on IndusInd Bank outlook and the outlook, especially for this particular stock. Any specific things that you want to highlight, Sumit, for looking at IndusInd now into the portfolio?
Sure. See, if you look at this bank, after ILFS crisis, it had its own share of challenges. Growth got impacted. Recently, we saw provisions also being elevated. Now we see most of these things kind of starting to normalize. Growth has improved, provisions kind of normalizing, ROAs kind of getting better, and ROE is also kind of starting to normalize, and valuations are at. So to that extent, it's a decent combination of wherein we can expect earnings growth to be X, but value creation could be X plus, and which is why we have kind of included IndusInd in our portfolio.
Okay, the next question which is coming in is especially for two stocks which have actually not participated in the run-up that has happened in last 2 months. One specifically being Avenue Supermarts and the other being Patanjali. Both of them have not been the way the other stocks in our portfolio have shown recovery. Anything that you want to highlight, Sumit, on both these stocks right now?
See, in case of Avenue Supermart, it's a pretty decent long-term story, because if you think about how he has executed his business over the last many years, I mean, it's one of its kind, right? Not many retail businesses have actually been able to kind of show this kind of growth with decent ROC and very limited dilution over the last years, right? So what is playing the stock at the current point in time? It's more into grocery. It tries to extract a higher share of individual wallet. But if you think about his execution at the current point in time, it gets business from FMCG, food and non-food, and also general merchandise. While food, or rather FMCG business, is a crowd puller, it allows footfall in the store. General merchandise actually gives them relatively higher margins. At the current point in time, because of how the K-shaped recovery has played out, the impact of inflation on the lower part of India's consumer has been relatively higher. The general merchandise sales actually has been lower than their overall business growth. So to that extent, margins have actually got impacted. We believe that this is more a shorter-term phenomena. The growth outlook is pretty decent, and once that normalizes, we will start to see a reasonable profit growth from the company. I would believe the longevity of growth in this business is really high, and which makes us positive in this way. And why is longevity high? Because it's still, I mean, close to about 200 stores still. Opportunity is significantly larger in terms of the way it opens store is more in a cluster format, and which is why the kind of expansions are more measured. Second one is about Patanjali. While business or rather stock price may not have performed, if you look at the business, there are three main pillars of value creation in this business. First and foremost, which is a very interesting pillar, is about foods business, right? This is any which ways the foods arm of Patanjali Group. That business has grown really well. It is already about 6,000 crore size. When I say food, I mean non-oil business, food non-oil. That is already about 6,000 crore size. And we believe that this business should record 15 to 20% growth for at least next few years. And margins which actually should continue to improve from here on. This quarter, we have already started to see normalization in that business. And the way there is a penetration-led opportunity for Patanjali in India. I mean, not many brands actually have got created over last 15 years. Patanjali is one such which has got created. We believe that the scope of a decent earnings growth on the food side is reasonably high. So why has stock not done well? The edible oil business actually gets impacted when commodity prices goes down pretty sharply. In the quarter gone by, we've seen palm oil kind of going down very sharply, and that has impacted margins in that business. Are those sustainable margins? Not really. Sustainable margins are going to be higher than what they reported in the quarter gone by. It's a pretty decent cash cow. That business should kind of grow 7 to 8% over next many years. Has it grown at that rate in terms of profits? Not really, because of the sharp impact on palm oil prices in the year gone by and also the quarter gone by. But we believe that that's more transitory, and we should start to see normalization starting Q1 itself. Obviously, difficult to predict in the shorter term how commodities would behave, but at least so far the violence is limited. But that's a key monitorable. Has it taken away the ability of the business to generate sustainable cash flows? Not really. Third and very interesting piece is palm oil plantation business. The palm oil plantation business is a very interesting piece. Once you kind of plant seeds, it takes about 7-8 years for the flower to kind of blossom. And at that point, it becomes a very sustainable annuity. So we believe that this business, which is about 200 crore profits at the current point in time, can be significantly bigger over next many years. So to that extent, the drivers of value creation are in place. The business got impacted because of vagaries of commodity prices, and stock may not have done well, but our confidence level on this business doing well is reasonably high. And at the same time, valuations are also pretty interesting. From about 24 rupees odd earnings in FY23, we anticipate earnings to inch up to about 40 rupees. So a very solid, and that's more driven by normalization as well in this year. So we remain pretty positive on the name.
Yeah, very interesting question, Sumit. We have got questions for stocks not doing well, but now is a reverse question which has come up with AU and Chola almost at their lifetime highs for these particular stocks. What's our view on these particular stocks? Do we plan to exit these stocks, or there is still this growth potential which continues to be there in both these stocks? What's our inputs on these particular stocks from here on for these two companies specifically?
So clearly, see, first and foremost, we look for businesses where opportunity size is large and growth is secular, right? And that effectively would mean that the opportunity for quite a few of our businesses should be there for many years. So what's the outlook on Chula? They no doubt are increasing share in their automobile business, whether it is CV or they have gone into adjacencies over period as well. So they have increased the share of PVs in their AUM. They have increased the share of two-wheelers, tractors, and which has allowed them to kind of grow at a rate faster than the growth in industry as well. So ability to get into adjacencies is a very important aspect. So that's one area, vehicle finance, which has grown really well. Along with that, they have also entered into some bits of consumer financing digital businesses as well, or rather lending to SMEs as well. And this is new area that they have added and which have led to decent growth for them. It's just start of growth for them in that area. And no doubt, this has been a business that we have held on for many years. While we may have trimmed some position there in last 3 months, but we continue to remain positive on the overall growth profile. And if you think about ROE as well, not many lending businesses would have ability to kind of grow upward, to report ROE upwards of 20%. Here is one such NBFC which has done that. I would think longer term 18 to 20% ROE and almost similar profit growth is something that we should expect from this business. Coming to AU, again, their runway for growth is large. In fact, they are one business who has actually been investing for growth. While this may continue, but over period, we believe that growth should be close to about 25%. FY24, we may not anticipate sharply higher or rather lower cost to income, but as this company is investing in growth at the current point in time, cost may remain elevated, but over a long period of time, we should start to see higher growth and improvement in ROE. So we continue to remain positive on this. Nagesh, you are on mute.
I was waiting for this question to come in. I think this is one of the questions which we get every time on the call. So with Bajaj Finance reaching the size which it is currently, isn't it expected that the returns are expected to moderate going further from Bajaj Finance? So isn't it a time to give away Bajaj Finance and maybe look at buying something else in place of Bajaj Finance? Any views on that, Sumit?
Again, my answer would still remain the same, right? See, how much is Bajaj Finance as a percentage of total loan book? That's about 1.5%. While it may not be catering to the entire credit market, but yet its share is not very high, right? Over last many years, what has led to the higher growth of Bajaj Finance is A, growth in their area of operation, and B, consistently increasing the P&L line items as well, or number of P&Ls as well, right? So number of P&L actually has gone multifold over last many years. Is this process that has kind of stopped? Not really. They would enlarge their scope on the automobile side. They would get into gold loan financing. And as it is, I still believe that they should, in their existing area of operations as well, they should kind of grow much faster than overall retail credit growth as well. So, and retail credit growth is growing at a rate faster than overall credit, right? So the growth setup is in place. How many lending businesses? I mean, if one were to think about Bajaj Finance X of their mortgage business, they have ROEs close to about 30%. Pretty decent ROE. 30% ROE in their business X mortgage, 23-24% ROE including mortgage. So a very superior earnings growth with very solid ROE. So these are businesses which we continue to like, while weights can be moderated at some point in time, but the growth outlook seems pretty decent there.
Okay, Sumit, some concerns on Dixon Technologies, which has been highlighted. There have been some losses which have got booked in the client's portfolio, and post that we have seen Dixon doing well in the recent past, maybe a couple of days time or weeks time, where Dixon has bounced back. Any inputs on that particular stock, Sumit?
See, I'll not doubt the opportunity for Dixon. I mean, India is too small in the overall electronic manufacturing space in the country. And Dixon again is while it may be one of the largest player there, but yet the runway for growth for Dixon is pretty decent. But we exited because execution wasn't playing out the way we had envisaged, and consequently we had to take corrective action in our portfolio. And we'll continue to monitor execution there. And while, yeah, the stock may have done well post our exit, but no doubt execution should have been better than what they have delivered, and which is why we had to take corrective action.
Okay, there have been some questions which have been coming on adding defense into the portfolio. So let me just jumble this question up. One is also on defense, and second, any emerging opportunities that we are looking. So there are questions which are saying, why aren't we looking at defense as a sector? And then any emerging sectors that are looking very, very attractive to look in future?
So yeah, defense is a pretty interesting opportunity. And again, it is, the way I would think about it is, it's all, I mean, most of the opportunity are also kind of playing out because of manufacturing in India. And defense is one such. It's right. So we are looking at this space in entirety. Do we mind having relatively higher exposure towards manufacturing in India at some point? We won't. So that's an area where we are kind of watching the space pretty closely. And when manufacturing does well, host of businesses actually starts to do well. Capital goods will do well. You will see businesses like chemicals or manufacturing for the world doing well. You will see EMS, I mean, Dixons of the world doing well. You will see APL Apollos, I mean, as we have relatively more, I would say, factories, more commercial premises, different way of kind of putting up the whole construction. That kind of plays out. APL Apollos of the world will start to do well. So to that extent, capital goods will do well, consumables will do well, logistic businesses will do well, staffing businesses will do well. So multiple areas actually starts to do well when the whole manufacturing in India actually does well. So we have a decent exposure, and that's a space that we are kind of monitoring it pretty closely. Climate change I talked about, right? That's area where we are kind of focusing pretty closely on, and the whole green hydrogen ecosystem. That's area where we would see dramatic investments, right? So multiple such areas where we should see things kind of getting better. The whole digital ecosystem would also throw open a lot of opportunity. I mean, if you think about Bajaj Finance as well, it also has been a beneficiary of how it used the whole digital ecosystem. So these are areas where we keep kind of focusing on.
Sure. Sumit, I think last few questions, one specifically on Sonacom. Okay, while we have seen recovery in Sona, which has been there recent, what is the outlook for Sona looking at its dependence on maybe global economy for business? While the India seems to be in a much better shape, globally things are still a little bit on a not so brighter side that India is. So what's your outlook on Sona at this point in time?
So see, if you think about most of the businesses that we have invested into, they are either beneficiary of India growth story, or they are beneficiary of supply chain dislocation that we may see. So kind of supplying either to few large companies or export being a significantly larger part. Sona is a bit different. Sona is in an industry which is in a way cyclical as well, gets impacted because of, the industry can get impacted because of global vagaries. But at the same time, this industry is seeing pretty sharp change in the way in which technology is being used. So whether world goes towards hydrogen cells from an engine perspective, or probably electric vehicle or plug-in hybrid, we'll have to see. But what is certain is significantly higher usage of electronics in automobile, right? So to that extent, they have a pretty decent business, which or half of the business kind of caters to the electronics piece overall, and we have a pretty sanguine outlook on that side. The balance half of the business is caters to, in a way, it's a forging business, caters to electric vehicle and other pieces, which again, overall, we see that electric vehicle kind of globally kind of doing really well. Penetration is low, and it should continue to do, or rather EV penetration should continue to increase pretty decently, and which is why both the parts of his business over long period has scope to grow pretty reasonably well over next many years. So we anticipate electronics doing well, and the whole differential assembly and differential gear business kind of doing well, and which is why it has place in the portfolio. So we actually don't want to focus on businesses which are on the receiving end of the technology curve, right? Because those businesses which are at the receiving end of the technology curve, value creation in many of such businesses could be lower than growth in profits. Only when we believe that the terminal growth is more certain, that is where we believe lies an opportunity for value creation, and that is where Sona Comstar actually from an opportunity fits in.
Sure. One more question which has come up now, Sumit, is, while we are very clear that why a particular stock will be a part of our portfolio, okay, so if it meets our requirement of promoter holding, profit before tax, ROCs, earnings growth, while that stock falls into our universe, and then ultimately whether it comes into the portfolio. But it will be very interesting to know what helps us to decide if a particular stock has to be exited. Is there any parameters that has been mentioned rather than qualitative, or is there any quantitative numbers which will help us to ascertain if a particular stock needs to be exited from the portfolio?
See, while many things don't change, obviously that is something we'll have to keep looking for. But since we look for opportunity which is really, really secular, that don't change in the short period of time, right? So what at all points in time we keep focusing on is, one, how has the execution been of the management? If the execution is decent, but the environment is kind of bit muddled from a short-term perspective, but longer term, the environment is pretty decent, our ability to really be in that business will be relatively high. So we would keep focusing on, in a way, this would translate into whether this business is able to protect its market share without having an impact on capital efficiency. If this thing is there, we would be more than happy to give a relatively larger role to the management. But if business execution is lower than what we have envisaged in the macro environment, because obviously macro is something that will be volatile, then we will have to accordingly take calls in those businesses.
Right. I think one last question which has been there while this call is for IP specifically, but there is one question which got highlighted that should one switch from India Select to IP, considering that recent performance of IP and everything. What's your take on that, Sumit? Because as a deputy CIO, what's your take on both these portfolios, whether it is IP or India Select portfolio?
See, it's never easy to answer this question. Right? See, our whole idea is to make sure that all the portfolios perform, right? Whether it is IP or India Select or any other portfolio that comes out of ASK stable. IP has a unique positioning. It focuses largely on entrepreneur-based businesses. And those entrepreneurs' ability to really kind of create value is really high. India Select has a much bigger canvas to play on. Not only it can invest into Indian entrepreneurs, but it can also invest into businesses which can be professionally driven or which can be owned by multinationals or public sector undertakings. Right? So our whole idea is to make sure that both the portfolios kind of perform reasonably well over a long period of time, and that is what we will kind of endeavor to do.
Sure. I think most of the questions have been answered. I think there are no further questions which are popping up right now. Let us wait for a minute. Friends, if you have any questions, please type it now. I can ask Sumit to answer those questions. Okay, there's a question which says, why underweight on banks?
No, so overall exposure towards financials is almost similar to that of the benchmark. While we don't create portfolios basis what the benchmark is, this is more incidental. But banking, or rather a lending piece, is a very, very large part, large opportunity, growing well. And if you think about it, I mean, purely banking credit book today is about 138 lakh odd crores. So let's say for sake of discussion, 140 lakh crores. If it grows close to about 15%, it means incremental lending of 21 lakh crores, right? So that's a very large opportunity, not only for banks, but for NBFCs as well, right? Within that, what we have done is we have focused on players which can grow fast and can grow with a decent or rather higher ROE. And higher ROE will come only if you have significantly higher command or higher understanding of your customers, because that would lead to a relatively lower credit cost, which in turn flows to ROA. Right? So our focus is growth and ROA, and NBFCs in many cases offers that good combination. FY23 was a year where interest rates were going up. Many of the banks actually saw consistent increase in NIMs. We believe the scope of NIMs expansion for banks should not be very high from here on. In fact, there could be pressures on NIMs from here on. But for NBFCs, those should not be very large, and which is why we have relatively higher exposure towards NBFCs versus banks.
Yeah, I think one more question which has come up is for Asian Paints, which has been, it has been observed that Asian Paints is losing some market share with competition coming in from Grasim, MRF, and all these players. What's your take on Asian Paints? Will it still continue to be there into your portfolio, or what do we look at it?
See, we will have to closely watch out for how Grasim's entry will play out. Grasim, no doubt, is a pretty serious player, committing significant amount of money. Their plant should be up, and I mean their sales should start probably a year down the line or 10 months down the line. But this is a business which is not easy to kind of penetrate, right? MRF has been there in this business for many years now. Similarly, many of the international companies, likes of Sherwin-Williams, Jotun, have been there in, or rather tried India entry for a length of time. But, this is a business where you need to go to the small retailers as well, and it is not easy to get their shelf space. So entry barriers are that much higher. And here is a management which is pretty agile, increasing their distribution reach and the kind of focusing pretty much on kind of increasing their revenue. Not only they have a pretty solid paints business, they are also diversifying beyond paints as well. Right? So they have built a pretty decent adhesive business. Right? So they are also getting into kind of bathware. So this company is actually transforming over into significantly more products as compared to pure paints. Will it be visible in the short period of time? Probably not, because paints is a pretty sizable part of their overall business. But the stance to get into, to become a significantly bigger offering into building products has already started. And so far, we have not seen they losing market share at the current point. Right? We'll have to clearly closely watch out for. Multiple entrants have tried in the past, and in none of the businesses we can ever say that there is going to be no competition. Competition will be part of the game. The management's execution prowess should lead them to defend their market share positioning and continue to get better.
No, there are a few more questions which has come in, Sumit, right now. Now, there is one question which has come up saying that does ASK not look at price while buying stocks, and especially quoted for two stocks, Bharti Airtel and IndusInd, which have been bought in at a relatively higher price, while you have answered for IndusInd Bank, why you find it comfortable now to look at IndusInd. Maybe Bharti Airtel is one example which has been bought at a maybe reasonably higher price, is something which has been asked for.
See, if you think about many of the businesses that we have owned for many years, many of them have consistently reported new all-time high year after year after year after year. And why has that been possible? That has been possible because these businesses have consistently delivered onto profit growth with superior capital efficiency. That has allowed them to kind of report a decent cash flow growth, which is in a way helps create value. If you think about Bharti Airtel, I think time has come where they would be beneficiary of market share expansion, ARPU kind of continuing to grow, customers moving from 2G, 3G to 4G, 5G, right? And that should lead to profit growth higher than kind of revenue growth. And we believe that CapEx also will also kind of not increase pretty sharply. So effectively, we now have reasonably higher confidence that cash flow growth will be higher than profit growth, which itself would be higher than revenue growth. And when that happens, chances are high that value creation will be higher than growth in cash flow as well.
Sure. Get what you're saying. Any outlook on Jio versus Bajaj Finance, Jio Finance versus Bajaj Finance, something that is shaping up now? Any inputs over there?
See, whenever somebody comes up with significant capital, that's an area where we'll have to closely watch out for. Having said that, finance is not an easy business. Finance is a business where there is a lot of friction that is involved. You lend and you need to take money back as well, and you need to continuously monitor, and taking that money maybe in tranches or can be one time, right? So to that extent, the friction involved is pretty high, unlike many other businesses where you put up large capex, which gives you a significant or rather durable advantage in terms of cost, right? So we'll have to really see as to how this new entrant actually kind of plays out. And I mean, if you were to think about it, Jio may have significantly higher advantage on the consumer durable side or consumer electronic side, right? That's one of the area of Bajaj Finance. Right? It's not the business in entirety, while a very profitable one, but we will have to clearly see as to how the overall scenario plays out. Overall consumer durable AUM is less than 15% of total Bajaj Finance AUM. So it can be, I mean, and opportunity size is large. I believe the overall consumer durable space itself should grow at a pretty decent pace as India kind of sees higher income level, and financing there is still not completely penetrated.
Last question, which has come, and this is related to the P of the portfolio. The P of the portfolio and stocks which are there seems to be pretty high at this point in time. Okay. In spite of the correction that we have seen in the portfolio stocks, what's your take on that? Will there be some derating that could happen, or is there something which is getting built in? What's your take on that particular point, Sumit?
See, we've already seen decent amount of derating in the portfolio P, right? All I can say is interest rates, to our mind, which also has a bearing on, or rather, which has implication on cost of capital, which in turn has bearing on PE, should not be such a big concern going forward. And as it is, portfolio PE has come down while earnings growth has continued to remain pretty decent. And if I look at earnings growth and capital efficiency, it remains pretty high versus what it is for Nifty 50 as well. So can one say with that P can't derate from here on? I don't think anybody can really say that. But given continued growth in earnings, given continued ability of these management to be increasingly more relevant, and in an area where opportunity is large and will be significantly bigger as we kind of progresses, we should see pretty decent value creation from the portfolio.
Sure. I think no further questions which are coming up. I think it's already 5:30, so I think we have overshot our time already. So Sumit, thank you very much for your time. I think that was a very, very insightful session. Most of the questions I think have got answered. I think all the questions which have been asked have been answered, right from the reasons for underperformance into the portfolio to what is expected to happen. I think I will end this call by saying I think this is a very good opportunity for all of us to maybe look at topping into the portfolio. It provides us an opportunity to get better returns going on. I think that's it from our end. Final words from Sumit, if there are any.
Thank you. Thanks a lot for joining in. We'll keep doing this session every quarter to showcase as to how the businesses are doing, and hopefully it benefits everyone. Thanks a lot for participating.
Thank you. Thank you very much. We end the session now. Thank you.